Good afternoon, and welcome to today's webinar, titled Captive Insurance Basic Taxation. This webinar is presented by the New Jersey Captive Insurance Association. Our guest speaker is Harry Baumgartner of Bressler, Amory & Ross of Florham Park, New Jersey. This webinar is sponsored by Per Knight of Jersey City, New Jersey. This webinar will be recorded and available at www.njcia.org after its completion. During the webinar, you can ask questions and send them to the presenter by typing in the question box on the right-hand side of your screen. The webinar's agenda will include the following topics: qualifying as an insurance company for federal tax purposes, discussion about the New Jersey premium tax structure, a discussion about mini-captives under the Internal Revenue Code, and some of the implications of the Dodd-Frank Act. Our schedule today will include this introduction, the webinar presentation of about 25 to 30 minutes, some closing commentary by Per Knight, and a question and answer session of about 10 to 15 minutes. I'd like to introduce our guest speaker, Harry Baumgartner, of the firm Bressler, Amory & Ross. Bressler is located in Florham Park, New Jersey, and it's a full-service insurance law practice, and it specializes in captive formation and regulatory compliance. Harry is a former general counsel at GAB Robbins, North America, where he worked with property and casualty claims administration as well as captive claims management. Harry is also a former treasurer of legal services at an industrial corporation. At that organization, he formed and operated a Vermont captive. He also merged and acquired captive and then associated with 2 offshore captives. Harry's a legal counsel in the formation of New Jersey captives at Bressler, and he's also a member of the advisory board of the New Jersey Captive Insurance Association. Our sponsors, Per Knight, are a Jersey City firm that specializes in risk services for alternative risk transfer markets. Some of their specialties include actuarial services, captive feasibility studies, domicile selection, captive formations, captive management, insurance program analysis, risk management consulting, loss portfolio transfers, captive closure solutions, and board of director services. I'm your host, Greg Scambatti of the New Jersey Captive Insurance Association. We now welcome Harry Baumgartner to discuss the topics at hand.
Thanks a lot, Greg, and welcome everybody. Glad you can join us today. Just to begin with a disclaimer, we're going to be talking about general issues here with respect to taxation of captive insurance companies, and your situation, whatever it may be, from the standpoint of forming a captive or operating a captive, may be entirely different than what we're about to talk about. So nothing that we say here should be relied upon. If you've got an interest in forming a captive or moving a captive or restructuring your captive, you need to consult with your own tax, legal, or accounting advisors. So today we're going to talk about Captive 101 taxation issues, which means we're not going to get into great depth on any advanced taxation issues. And I want to begin by setting the stage by saying that what we'll talk about is a domestic environment in which we have a domestic corporation and a domestic captive. We're not going to get into offshore captive issues as they relate to taxation, because that can become quite complicated and take a substantial amount of time, and certainly more time than we have today. So that's how we're going to go about dealing with this. And also, by virtue of introduction as well, the history of captive taxation has been going on for some 35 or 40 years. And it began back when the IRS originally took the position that captive insurance was not real insurance, and for tax purposes it did not allow initially the deductibility of premiums or the acceleration on loss reserves, anything like that, because it viewed it as self-insurance. Well, the Internal Revenue Service lost and a couple of court cases way back when, and that started the evolution of captive formation in the United States and the treatment of taxation within the context of captive organizations. And it has evolved over the course of 35 years until where we are today. And it begins effectively with what is insurance and why is taxation important to an insurance company. And we'll begin with the latter part of this. Why is it important from the standpoint of taxation? Well, a couple of things. Premiums that are paid to an insurance company by a policyholder are generally deductible as an ordinary business expense. So if you have a properly structured captive, your subsidiaries, if you will, or affiliated companies that are insured by the captive can deduct those premiums as ordinary business expenses. There are some exceptions. We'll get into that a little bit later. And the most significant element of federal taxation from the standpoint of a domestic captive is that if it's properly formed and operated, the captive insurance company, like other insurance companies, may have the ability to accelerate the deductibility of their claim reserves. This is unlike self-insurance, where you do not have that ability, and you cannot take a deduction as a business expense until an actual claim is paid. So that presents a significant tax advantage for companies, and captive formations are, to a certain extent, driven by that evaluation. Let me also say, though, that it goes without saying that the formation of a captive should not be done solely for tax purposes, or even principally for tax purposes. You want to do it for a variety of risk management reasons, and tax is really only one of them. So the question then becomes, are premiums paid to captive insurance companies treated as deductible third-party insurance, or as non-deductible self-insurance? And that comes down to the definition of what is insurance and how it's applied in a variety of scenarios that we'll discuss in a short while. And then, can captives accelerate the deductibility of their claim reserves, which follows basically the same analysis. So, how do you qualify as an insurance company for federal tax purposes? The key question from the IRS and the courts that have ruled on these matters, it comes down to whether or not the captive insurance company is a bona fide insurance company. What does that mean? What is a bona fide insurance company? Well, that means that there is something other than a non-tax purpose for its existence. It has a legitimate insurance business purpose. We'll talk a little bit more about that later. It involves a genuine insurance risk, and that means that there is fortuity involved. There is a risk of loss due to a fortuitous event. It's not, for instance, an investment risk. It's not a risk that you know will occur at some point. You just don't know when. It has to be fortuitous. Thirdly, there are certain indicia of insurance that are used in the tax courts with respect to what is and is not insurance. We'll talk about that in a bit. And then there are key elements involving risk transfer and risk distribution, which form the foundation of the discussion that we'll get into in a minute as well. So, what are common indicators of insurance, and how can a properly structured captive demonstrate these indicators? Well, there has to be appropriate capitalization. That means, from the standpoint of the IRS, for instance, that parental guarantees are not involved. That means that, when the IRS looks at parental guarantees as being something other than a distribution or a sharing of risk. In other words, if the event or the policy that you are insuring is guaranteed by some third party, including a parent, not necessarily reinsurance, but a parent, well, then that's not appropriate capitalization in the eyes of the IRS. Is the captive appropriately reserved? Do you have appropriate actuarial support behind your reserving? Is your pricing with respect to the issuance of your policies done at arm's length, market prices? Have you issued appropriate policy forms? Are you involved in standard insurance company investments? And in that regard, one of the things that the agency will look at is whether or not you've got investment in affiliated companies through the form of related party loans. They'll also look at the corporate formalities. How is it structured? Is it independent, legitimately independent from the rest of the business? Is there an appropriate separation of accounts? And what is the non-tax business purpose for which you have established the captive? The two key things that I mentioned earlier are risk shifting and risk distribution. So what is risk shifting? Well, it's a transfer of the financial consequences of a potential loss such that the insured, the policyholder, remains unaffected because the loss will be offset by an insurance recovery. That gets back to what we talked about a couple of minutes ago, is how is the captive capitalized? Are there guarantees? Is there arm's length pricing? Has there been an appropriate shift of the risk of loss from the insured to the insurance company? Risk distribution. Well, that means risk sharing among different entities. That allows the insurer to reduce the possibility that a single claim may exceed the ability to pay. This gets into the law of large numbers and whether or not you've got an appropriate distribution of your potential losses across a sufficient number of insureds such that any particular loss by any individual insured does not break the bank. It means that you've got an adequate pooling of your premiums and that there is an appropriate distribution such that it does not give the appearance of being self-insurance, and we'll talk a little bit about that. So how do you meet the risk distribution test? And this is the nub of the issue in the view of the IRS analysis. There are two ways to meet the risk distribution test. One is by demonstrating that your captive has sufficient third-party or unrelated business in the captive. And the second way to meet this test is by demonstrating an appropriate corporate structure that is called a brother-sister arrangement. This chart reflects risk distribution in the third-party risk scenario. What does that mean? It means that your captive is insuring the risks of related entities to a certain extent, but it also is insuring what qualifies as unrelated risk, whether that be genuine third-party risk from unrelated companies or unrelated entities, or through a variety of other mechanisms that may be involved in the structure of the captive and the risks that it is insuring for the affiliated companies. For instance, certain warranties, employee benefits, things of that nature may qualify as third-party risk that meets the test necessary to demonstrate adequate risk distribution. The key in this analysis is how much third-party risk is the captive insuring. If there is 90% of the risk is resident in the affiliated companies, it's not enough, the IRS has said, and therefore you don't meet the third-party risk test. The safe harbor rulings from the IRS indicate that 50% of unrelated risk can meet this test. There are some tax court cases that reduce that percentage by a not insignificant percentage, and it all depends upon the circumstances of your particular captive, your particular company, what it is that you're insuring, and so on. But the IRS has said if you've got 50% of unrelated risk in your captive, you're probably okay. That doesn't mean that's the number, but it means that you've got a safe harbor from the IRS under Revenue Ruling 2002-89 under that analysis and those percentages. In the second scenario, the brother-sister approach, there is no third-party risk involved per se, but rather it involves the parent and multiple subsidiaries being insured by the captive. The key question becomes how distributed is this risk? if you've got, as I said earlier, a substantial amount of concentration in the parent, for instance, let's say there's 90% of the insured risk is up in the parent corporation and only 10% is in the subs that are shown on the screen, probably not enough. The test seems to be that there be an adequate distribution throughout the subsidiaries to the point where you can meet or demonstrate that there is distribution under the law of large numbers, that any one particular loss is not going to break the bank, and that there's adequate percentages of risk distributed through the other companies. There are a variety of rulings and guidance letters from the IRS on this, and it will depend upon your particular structure and your particular situation. The thing to recognize on this chart is that in the context of the brother-sister approach to meeting the risk distribution test, the premiums that are paid by the parent to the captive are not tax deductible, but the premiums paid by the subsidiaries to the captive are tax deductible. It's also important to note that the IRS will entities that are disregarded for tax purposes don't qualify for purposes of this analysis, meaning that if your results are rolled up and they're not treated as and they're disregarded entities for tax purposes, you cannot deduct those premiums either. So if any of these subsidiaries on this chart are either not legal C corporations and are disregarded entities for tax purposes, then that applies and you can't deduct those premiums. That, in general, describes the overall view of how the federal government and the IRS, obviously in particular, looks at captives with respect to the demonstration that it is a legitimate insurance company for federal income tax purposes. And we recognize that that is a very brief overview, and there have been many decisions that support the risk sharing, the risk distribution, and the definition of insurance factor, but we'll talk about that in a future webinar on more advanced topics. What we want to move to now is a discussion of what are called small captives or mini captives or micro captives, and some refer to them as 831B captives. And these are captive insurance companies that are set up pursuant to the Internal Revenue Code section 831B, ergo the name. It is an election that the captive can take that will qualify the captive as an insurer for federal tax purposes. You have to demonstrate all of the things that I previously described, that it is a legitimate insurance company, that it meets the definition of insurance, that it has adequate risk shifting, and that it has adequate risk distribution through the mechanisms that were previously described. The election allows the captive to be taxed on its investment income only, and that means that its underwriting income is the only income that is taxed at the federal level. You still have to pay your state premium taxes, but the benefit that you get here is as follows. Well, you also are limited to premium payments into this captive of up to $1.2 million per year. So the example that's at the bottom of your screen demonstrates the front end of this analysis, and that is, let's say you have a small company or a family-owned business or a middle market company, and it sets up a captive to insure legitimate insurance risk. On an annual basis, it has the ability to, the captive has the ability to take in $1.2 million in premium income. So if the parent company or if the insured entities that are insured by this micro captive or mini captive pay into the captive $1.2 million in premium, that reduces the income reduces the taxable income from those insured entities. And let's assume there's a 40% tax rate, and who knows where the fiscal cliff will take us as far as tax rates go. But from the immediate outset, the taxable income of the insured entities can be reduced by 40% of the $1.2 million, which represents $480,000. That's the first step in the analysis. Before we get to the next step, let me point out that if companies make this election, and it is an election, it can generally only be revoked with the approval of the IRS. So you've got to be in this for the long term. It's not something that you can move in and out of year over year. So this is how it works, or how it looks from the standpoint of a generic 831B captive. On the left of the screen is the captive owner, and that may or may not be the company that is being insured. It can be, for instance, heirs in a family-owned business, or other entities in a properly structured 831B scenario. And so you have on your left the owners of the captive, and on the right the insureds, which are the businesses that are, or the individuals that are involved as policyholders in this process. The insureds, as I said earlier, pay their premium into the captive, thereby reducing their taxable income, and they are paid claims to the extent that any claims are made against the captive. The owners of the captive may or may not be insureds as well, and may or may not receive claim payments depending upon whether they are insureds and whether they have any claims. And but they are the ultimate beneficiaries of the captive. And so year after year, as your premiums income builds up in the captive, and assuming that there's no significant losses, you are building up your capital and your surplus in the captive. And over time, hopefully you get to the point where you have excessive capital, excessive surplus, and have the ability to dividend out to your owners. In that scenario, you, again, this has to be a properly structured 831B captive. The captive can distribute in the form of dividends to the owners of the captive. So at the front end, you have the policyholder, which is taking the deduction as a business expense for the premiums that are paid into the captive. And then, ultimately, when the captive is sufficiently or overly capitalized and has sufficient surplus to meet its needs, it then dividends out excess at the dividend rate. So now the dividend rate is 15% or so now. Again, we don't know where that's going to be, or the capital gains rate, I'm sorry, is the dividends are taxed at the capital gains rate, 15%. We don't know where that's going to be at the end of the year, given the fiscal cliff debate that is going on in Washington. But if you do the math, you can see how that nets out to be a positive tax arbitrage for an 831B captive, assuming that it's properly structured. And I can't emphasize that enough because, at some point the IRS will find one that is not properly structured, doesn't have adequate risk distribution, doesn't have the risk shifting that's required, and isn't legitimate insurance. It has to be properly structured. But the growth in the captive marketplace over the last couple of years has been in the 831B space. Some states in particular are actively promoting it, and hundreds of these captives have been formed over the last couple of years. So from a estate planning standpoint, this is an ideal solution, again, assuming that it's properly structured for family-owned captives or privately held captives. Middle market companies are looking at this. It's structured, as I alluded to earlier, where the captive may be owned by the heirs to the business owner, and it potentially shifts the wealth from the higher tax rate individuals to the lower tax rate individuals over time. Profitability, of course, is dependent upon the types of risks that are insured, type of underwriting profits that are generated by the captive, or losses. And as I said earlier, this is not a short-term arbitrage. This has to be planned for over a not insignificant period of time, and so on. Shifting gears again, we're going to talk a little bit about the Dodd-Frank Act and its potential implications for captive insurance companies. The Dodd-Frank Act included a provision that was it's known as the Non-Admitted Reinsurance and Reinform Act of 2010. It became effective in July of 2011. That portion of the Dodd-Frank Act applies to surplus lines and self-procured insurance from non-admitted insurers. 34 states have self-procurement taxes, and New Jersey is one of them. And New Jersey's assessment is 5% on the gross written premium of what is defined as self-procured insurance. Now, let me back up. This is a mechanism, this law, this act, for collecting the tax. It didn't change tax laws per se. The self-procurement tax has been in effect in most of those 34 states for quite some time. And if an insured was acquiring surplus lines insurance or other non-admitted insurance, meaning insurance that was not admitted in the state of a particular risk, there always has been a requirement that you were supposed to pay whatever the percentage tax in that particular state was. The way it worked, though, was as follows. The amount of premium that you paid for surplus lines or non-admitted insurance was supposed to be distributed on a pro rata basis to all of the states, the tax distributed to all of the states, based upon the percentage of risk that was insured in any particular state. So if you had, a large tax obligation because you have a substantial amount of risk throughout the United States, and a substantial amount of that risk, let's say it's property and it's done on a valuation basis, is in Texas and Louisiana and other Gulf Coast states that have this tax, but your home state is New Jersey, you're always required to pay that pro rata portion of the self-procurement tax to those Gulf Coast states. Some companies did it, some companies didn't. Some companies only paid the proportion of the tax that may be applicable in their home state. It's a self-reported tax, and the compliance levels at various companies varied. What the Non-Admitted Reinsurance and Reform Act of 2010 did said, we need to streamline this process because it's too complicated and it's very difficult to deploy, let alone enforce. So the NRRA developed a two-fold plan to streamline that process. It said, first of all, that only the home state, and home state is a defined term in the Act, has the ability to collect this tax, first of all. And by that I mean the tax that would apply on a national basis. And secondly, it said, and we encourage the states to enter into a compact whereby they then would distribute the collection of those taxes based upon the proration of risk located in the individual states. What has happened is that the second prong, the encouragement to enter into a compact, a national compact, to efficiently distribute this tax, hasn't occurred. And what many states have done have said, okay, now I have the authority to collect this tax on a national basis and keep it. So if you are in a state that has a high concentration of corporations that may have out-of-state captives, that means that, and that could be New Jersey, New York, Connecticut, all of which have captive laws, they then have the ability to say, okay, we are going to assess in New Jersey's case, 5% tax on all of the surplus lines and non-admitted insurance that you are acquiring, and keep it. So while the goal was to eliminate the inefficiencies of this multi-state system, it has evolved, at least in the short term, since 2011, into something else. The question is, does it apply to captives? And what does that mean with respect to either forming a captive in any particular jurisdiction or redomesticating an existing captive from one state to another? Some states, and in particular Vermont, which I'm sure many of you know is the largest captive jurisdiction in the country, say no, that this element of the Dodd-Frank Act was not meant to apply to captives. And they look to the legislative history, the background reports, the committee reports that were generated prior to the enactment of the Act, and argue that it was meant to apply only to surplus lines, not to captive companies. The fly in the ointment with respect to that analysis is when you review the four corners of the Act itself and examine the language, it permits a potentially different interpretation. And that interpretation would hold, pursuant to the definition, that captives, to the extent that they are not admitted in a particular state, namely the home state of the parent company, are non-admitted in that state. And the Act, the language of the Act, refers to both surplus lines insurance as well as other insurance, independently procured insurance, which is not admitted in the particular state. So if you have, for instance, a Vermont captive and you are a New Jersey corporation, your home state is New Jersey, one could argue as a technical matter under this law that your captive and the insurance that you acquire from your captive based in Vermont is not admitted insurance. Therefore, New Jersey has the right to assess a 5% self-procurement tax against all of the premium that's going into that captive. Now, this does not apply if you've got a captive, for instance, that's properly fronted by an insurer that is admitted in the home state. But to the extent that you don't have that arrangement, it may. The thing you have to do in the context of this analysis is to review the particular statute within your state, namely New Jersey in this instance, to determine exactly what its language says with respect to the self-procurement tax, to what tax does it apply, and whether or not in that evaluation it applies to captives or not. What has happened as a result of this development is that it has substantially raised the awareness of the various state taxing jurisdictions and otherwise about the existence of this issue and of this tax. And in these times of financial stress for many states, it is an additional source of revenue. So, what does it mean if you've got a captive that's already located outside of New Jersey and your home state is New Jersey? It means you have to conduct that analysis to determine whether you've got that risk, and if you believe you have that risk, whether it is efficient for you to move your captive from whatever jurisdiction it may be in back into New Jersey, thereby becoming an admitted insurer in the state of New Jersey, not subject to this tax. The issue is being raised by auditors from the standpoint of reviewing companies that have captives that are not located in the home state of the parent company, which raises a question of materiality from the auditors and whether or not these companies should either be paying the tax, and again, you got to refer back to the specific laws in your state, or if not paying it because of the ambiguity that currently surrounds this issue, whether they should be booking it as a reserve, both of which, paying the tax or booking it as a reserve, is going to affect net income. Finally, and briefly, a little bit about what's going on in New Jersey. The New Jersey captive laws were enacted back in 2011 in February, became effective May 23rd. They are modeled exactly after the Vermont captive laws, which means they are very flexible, beneficial, a lot of opportunity to be creative from the standpoint of captive formations and redomestications from out of state into New Jersey. They allow, as Vermont and most of the other jurisdictions do, for the creation of pure captives, associations, industrial captives, branches, and cell captives. And to date, 5 captives have been approved in the state. There are, we know, several more in the pipeline, and there is an expectation that by sometime next year, there easily could be 15, 20 captives in New Jersey. It makes sense for many companies, big and small, to think about captive formation both as a risk mitigation strategy and as a consideration for your tax position. New Jersey, in modeling its statute and its regs against the Vermont laws, also adopted the competitive premium tax rate structure that Vermont has. And you can see there what they are on the screen. And the important thing to note here at the bottom of the screen is that there is an annual maximum aggregate tax of $200,000. So you could have $1 billion in premium in your captive. The maximum premium tax that you're going to pay in New Jersey is $200,000. Another significant reason for considering a captive as part of your risk management toolbox. With that, I'll conclude my presentation and turn it over briefly to Chris Ridge from Curran Knight.
Thanks, I appreciate it. Just want to make a few quick observations from the captive manager's perspective. Harry did mention earlier that we wouldn't go into any offshore tax issues, but I did want to point out just very generally that there used to be a lot of tax benefits associated with forming captives offshore. The IRS over the years has closed up the vast majority of those loopholes, and really the onshore versus offshore decision is not really particularly driven by taxes at all anymore, and it's really more of it's become more of an issue of operational costs, capitalization requirements, and really perception issues. Whether your shareholders, if you're a publicly traded company, or your customers have you might have a negative view of an offshore domiciled captive, whether that be justified or not. With respect to mini captives or 831B captives, as a captive manager, we see that there are a lot of captives start off small and grow. And as we're working with clients, it's a very important question to answer. If you're small now, do you intend to stay small? Because as Harry pointed out, you can't sort of jump in and out of an 831B captive. You have to make a decision for the long haul. And to that end, if you intend to stay small, that's fine. If you there are some structures that are being promoted out there that should be wary of, like the structures where you have multiple 831B captives owned by a single parent, just for the purpose of keeping each of them at $1.1 million or something like that. That obviously is getting a little too cute. The IRS is not likely to look kindly on those if they ever delve into it too deeply. You can certainly keep your captive's net premiums below $1.2 million through proper reinsurance structuring. Reinsurance arrangements are also critical when you're forming a captive and for the ongoing operation of the captive, that also help you reach those risk shifting requirements that Harry had mentioned earlier as well. But one other point I wanted to touch on are dividend distributions. Of course, when the captive starts to accumulate surplus, if it's profitable over the years, as surplus is accumulated, the board may elect to issue dividends back to the parent company or to the shareholders of the captive, which of course creates a taxable event. There are strategies involved in distribution of dividends that should certainly be considered to minimize the tax effects. One of the benefits of being owning a captive and being an insurance company is the ability to let your surplus accumulate and sort of sit there ready for a rainy day, a bad underwriting year. That's usually a much better strategy in the long haul than emptying out the captive of surplus at the end of each tax year. And you can also potentially reduce your premiums a bit over time. If surplus is building up, you may be paying in too much in premium effectively, and you can sort of avoid large dividend distributions that way. Ultimately, it's important to always consult with your tax professionals, guys like Harry, people like that who can give you good, solid tax advice. So that's it for me. With that, I'll take it back over to Greg.
Okay, thank you, Harry. Thank you, Chris. We'll make it possible now for you to ask questions. You can do that with the toolbar on the right-hand side of the control panel. Just simply type questions into the question and answer section. And we'll wait a couple of minutes to see if there are any questions. Pardon that, a couple of minutes, just another few more seconds. Well, okay, I don't see any questions coming up, and so at this point, I would like to remind everybody that the webinar has been recorded and will be posted on the website www.njcia.org. And I'd like to thank our presenters, Harry Baumgartner, and in a moment, if we'll see, I think you'll see at the end of this presentation his contact information again, and also like to thank Chris Ridge of Paranite. So thank you again to Bressler, Amory, and Ross and Paranite for their participation in this webinar. And again, contact information is available on the slides. It will be posted on the website, and do not hesitate to contact any of us for additional information. Thank you. At this point, we'll end the webinar.